Hello everyone, Kit here, back with another video. Today for you guys we're going to be reading the Unincorporated Business Trust, also known as the UBOT. I'll leave a link to this down in the description below, along with our email. You can email us at themuzzy@gmail.com for a private consultation. So without further ado, let me get right into it. This video won't be as long as some of the past ones that I did, just because this form is a bit shorter. So yeah. What is an unincorporated business trust, and what are its disadvantages? UBOT is an organization created and managed by trustees for the benefit and profit of beneficiaries who hold or may acquire transferable trust certificates. Trust certificates provide individual holders evidence of interest in the trust estate, assets, income. 2. A powerful entity by which individuals may combine their resources to operate a business for profit without the inherent inabilities of a partnership or the double taxation of corporations. A UBOT can preserve privacy, protect assets against judgments and lawsuits. 3. Often called a common law trust, but this phrase is not descriptive of any of the peculiar characteristics of such organizations. The basis for the terminology common law trust is that they are created under the common law of contracts and does not depend upon any statute for its existence. See the United States Constitution, Article 1, Section 10, Clause 1. 4. Brought into being by two basic documents, a declaration of trust and a trust indenture. These two documents make all the provisions of who is who and who is responsible for what, relative to the trust activities. 5. A great way to avoid tax liabilities of businesses or trust transactions until money or assets are distributed to the beneficiaries. Since the trust indenture is a contract between the creator and the trustee, the indenture controls the activities, powers, and responsibilities of those who administer the trust. No one has legal authority to change its provisions except those who are authorized by the indenture. Okay, up next is a basic graph that breaks everything down, so I'm just going to briefly go over this. Guarantor, the creator, which is you, establishes and brings into existence the trust which is created with. Trust indenture, declaration of trust, both go hand in hand. Creates trustee who act on behalf of beneficiaries holding trust certificates. Up here, declaration of trust accepts additional property onto the trust, only comes into play after the initial creation of trust. Exchanger, with the money, issues certificates from the trust, goes to the beneficiaries holding trust certificates. Yeah. Parties and the roles in the UBOT. How many people at the minimum do I need to create a trust, and what are their roles? Guarantor, the creator, of the person whom grant is made a transfer of the property. The creator of trust is usually designated as the grantor of the trust. Trustees, a person or one of a group of persons appointed to manage the affairs of an individual, institution, businesses, etc. A person who holds property in trust for another. Beneficiaries, one who benefits from act of another, one for whose benefit a trust exists, a person who receives or is named to receive money or property from a trust. Exchanger, whenever you or another party want to transfer any property into the trust organization in exchange for certificates, you take on the role of an exchanger. Benefits of a UBOT. What are the benefits and drawbacks of a UBOT? The benefits of a UBOT are 1. Privacy, 2. Limited liability, 3. Not subject to probate, 4. No state or inherent taxes, 5. Minimize and or avoid income taxes, 6. Maximize depreciation, 7. Reduce capital gains tax, 8. Separate investment program. The drawbacks of UBOT are: the drawbacks of the UBOT are when you create a revocable trust which subjects the trust to all the opposite benefits stated above. 2. Property put into an irrevocable trust is just that, irrevocable. No takebacks. 3. The benefits outweigh any drawbacks to establishing a UBOT. 9. Basic aspects of the UBOT. 1. A UBOT is formed by contract between the parties setting forth the purposes, terms, and conditions. 2. A UBOT is a legal entity and artificial individual with rights almost equal to a natural person, a human being, able to own property and conduct businesses like a natural person. It is irrevocable and no one has any reversionary rights to its assets. 3. The UBOT's assets are owned by its businesses, activities managed by the trustees who accept such responsibility as fiduciaries on behalf of the beneficiaries. 4. The beneficial interests are divided into capital units, evidenced by the issuance of trust certificates, conveying to the holder the limit rights to receive the prorate share of any distributions of income or assets that may be made by the trustees. 5. The capital units are personal property which conveys neither legal title to the property nor any voice in the management of the businesses or the selection of trustees. 6. A UBOT is subject to taxation on its distributable net income. The beneficiaries are only taxed on what they receive. 7. The assets of a UBOT are never subject to probate or tax because an artificial person, it never dies. 8. The capital units will become void upon the death of the holder, thus have no value to be subject to estate tax or probate. 9. The life of a UBOT can be extended as deemed advisable or terminated at any time by the trustees in accordance with the trust indenture contract. Statutory trust versus common law trust. A statutory trust is a legislatively created and regulated entity. Statutory trusts derive their existence from and is governed and regulated by statutes by which it must conform. Constitutional trusts are derived from Constitution in the form of contract. This right of contract is derived from the United States Constitution, Article 1, Section X, which states, "No state shall pass any bill of attainder, ex post facto law, or law impairing the obligation of contracts." Ex post facto law is defined as done or made afterward, from the thing done afterward. Constitutional trusts are created and operate under the law of contract established in the United States Constitution. The essential elements of the law of contract are absent in the creation of statutory trusts, but are present in the creation of constitutional trusts. The essential elements are: 1. Two or more parties at arm's length, not blood related. 2. An offer by one of the parties and acceptance by the other party. 3. Consideration in the form of money or money's value. 4. All confirmed, tied together by a meeting of the minds or the understanding of the two involved parties. 5. Contract is signed willingly by both parties. Basic comparisons between statutory and constitutional trusts are varied. Some are displayed in the below charts. The differences of statutory trust versus constitutional trust are: statutory trust is merely holds property till death, is usually a revocable trust, has a statutory termination date, protects and conserves property only, arises from statutory provision/regulations, legally and equity title is split, consolidation is not involved, and 8. Exercise of privilege. Constitutional trust is owns property in fee simple, is always irrevocable trust, cannot be terminated by statute and can renewed each 20 years, can operate as any businesses, arise from the law of contract, legal and equity title not split, consolidation is involved, and 8. Exercise of a right. Some court cases regarding trust. Elliott v. Freeman, 220 U.S. 178. A pure trust is not subject to legislative control. The United States Supreme Court holds that the trust relationship comes under the realm of equity, based upon the common law, and is not subject to legislative restrictions as are corporations and other organizations created by legislative authority. Schumann Hank v. Folsom, 159 NE 250. The basis for common law trust in this connection is not that such organizations are creatures of common law as distinguished from equity, but that they are created under the common law of contracts and do not depend on any statute. In Burnett v. Smith, 240 SW 1004, 1922, the court stated, "A pure contract trust is established by contract, and any law or procedure in its operation denying or obstructing contract rights, impairs contract obligation, and is therefore violative of the United States Constitution. And in Berry v. McCourt, 204 NE 2D 235, 1965, the court stated, a pure contract trust is a contractual relationship in trust form. And in Crocker v. McCoy, 649 U.S. Supreme 39 at 270, the court stated, a trust organization created under the United States constitutional right of contract cannot be abridged. Emphasis added. The following are documents used in the UBOT and proper uses thereof. Proposal: to invest funds for trust certificates. Right and wrong trust procedures. Right way. Conveyance of real property to the trust. Transfer the property to trust by warranty deed. Send copies to the redone, not the originals. Transfer to an individual for value received. Awards: no taxes. Details kept private. Not likely to be subject to pressure from promoters, salesmen, etc. No disclosure as to values involved when traded, exchanged. Penalties: disclose to public if any gain realized. Tax must be filled. 2. May subject you to pressure from immoral people. Conveyance of personal property to the trust. 1. Create a detailed list of all properties, personal, etc. 2. Add it to a schedule as part of your trust with no value specified. 3. Make a second list with replacement value specified and keep it in a separate fireproof safe. 4. In the fireproof safe or lockbox in the same name as a trust, keep the list of replacement values. 1. Listing only most valuable items or making no list at all. Specify items at cost value. Make this list with all your cash values specified as part of your trust. Keep this list in the lock in your name. Rewards: no capital gains recognizable. Able to provide a detailed loss to insurance company to collect insurance in case of fire or theft and regain the value of the property. 3. Avoid being taxed personally for property. 4. As a trust is an artificial entity and it does not lie, the trust can keep full value of the valuables in it, thereby saving tax money for the estate and providing probate. Penalties: capital gains will be evident and taxes payable. Proof of ownership can be difficult or impossible in the case of fire, making it impossible to collect fire or theft insurance to make replacement to the losses. 3. Capital gains tax may be levied, but can be deferred if reinvested within 18 months. 4. Lockboxes can be entered by IRS and seized by the bank pending probate in the event of death. Conveyance of the stocks and securities to the trust. 1. For transfer to the trust stocks and 1. Endorsing stock and securities should be street endorsed to the trust. Send this to the transfer agent as this avoids broker commissions. Rewards: establishes bona fide records as to transfer ownership of the trust. 1. Endorsing the stock and securities over to the trust, turning them over to your broker for transfers. Penalties: does not establish transfer of ownership to the trust and costs you a commission. 2. Will mean the stock may be subject to estate tax because the company record still shows in your ownership. Rewards: establishes bona fide records as a transfer of ownership to the trust. Conveyance of life insurance to the trust. Make the trust beneficiary. Make the trust pay the premium. Would make an irrevocable minute resolution. Make the trust the policy owner. 4. If possible, obtain new policy contracts. Rewards: keys proceeds out of spouse's estate, can save from 20% to 50% of estate tax. Release issued of ownership and removes probability of taxing proceeds. It will be acceptable proof to IRS that no premium will have been paid by you. This will save taxes. See number 3 above. Making your wife beneficiary. Paying premium personally. Retaining ownership as an individual. Keeping your old policy upon which you have paid. Penalties: adds to wife's estate, greatly increasing taxes liability. in evidence of ownership creating probable tax liability, increases taxable estate, percentage of premiums you have paid represent the percentage of proceeds that creates a probable tax liability. Conveyance and motor vehicles to the trust. Place vehicles in the trust name, assuring minimum rates. Awards. Important assets are protected from liability created by vehicles. You're personally protected from results of suit. The trust will pay the operating expense, use lease fees, etc. before tax dollars. Penalties. If held in trust with a large amount of other property, the other property of the trust can be put in jeopardy if the trust vehicle is in an accident or incurs liability. We suggest that a vehicle or other object can incur a large amount of liability, be it put into a separate trust from other true assets. And yeah, that's about it. I'll see you guys in the next video. Like, share, subscribe. I'll leave these links down in the description below. Along for email, you can email us at UBOT.com for private consultation. And I'll see you guys later. Bye.